capital gains tax. Students, please remember 2 points. Number one, it is lifetime tax. Lifetime tax means this tax will only arise if you will dispose of the assets or you will gift non-current assets during your life. When we will start IHT, students normally used to mix these two types of taxes. So see, capital gains tax is basically a lifetime tax. If an individual will transfer his assets after his death through his will, in that case, CGT will not be applicable. So it is a lifetime tax only applicable on those assets which are either sold or transferred or gifted during the life of an individual. If in your exams it is mentioned in the question that an individual has transferred an asset after his death, it means only IHT will be applicable, CGT is not applicable. Now, capital gain tax will arise number one, when a chargeable person makes a disposal of chargeable assets. When a chargeable person makes a disposal of chargeable assets, then capital gain tax will arise. The first term which I have written over here is chargeable person. The person who is going to pay capital gain tax is called chargeable person. That individual could be UK resident or non-resident. If the chargeable person is UK resident, we will discuss the rules in detail regarding UK resident individuals, but we will cover them in the income tax. Okay. For the time being, UK resident is basically a status in the UK. So if an individual is UK resident, he will pay UK capital gain tax on sale of UK and overseas assets. So a UK resident person will either transfer his UK assets or overseas assets. In both cases, he is going to pay capital gains tax. On the other hand, non-UK resident person, if an individual is non-UK resident, he will pay UK CGT only on UK property. That is the only asset which is chargeable. Okay, So if an individual is non-UK resident, he will pay CGT in UK, but only on his UK property. That is the difference between chargeable person. So chargeable person could be UK resident. In that case, he will pay CGT in the UK on both his UK as well as overseas assets. Alternatively, if an individual is non-UK resident, he will pay CGT in the UK but only on UK property. Second term is chargeable asset. Students, there is a list. There is a list of assets mentioned by the tax law which are exempt. So what are basically chargeable assets? All assets except exempt assets are called chargeable assets. All assets except exempt assets are called chargeable assets. So we will have to memorize the list of exempt assets. Starting with motor vehicles. Motor vehicles are exempt, and please remember, motor vehicle means only cars. Heavy commercial vehicles are chargeable. National saving and investment certificates, if you will have profit on disposal of these certificates, it will be totally exempt. Current assets are totally exempt. Cash, debtors, and inventory. Decorations awarded for bravery means any medals are exempt. Damages for personal injury may be from the insurance company. These are totally exempt. Shares in the VCT. Students, VCT stand for Venture Capital Trust. So this is basically share scheme for the employees. We will discuss it in income tax. So for the time being, if you will have any if we will have any VCT shares, any profit on these VCT shares is totally exempt. Students, these notes will be available before our next weekend. So I will try to finalize these notes in the upcoming week. Endowment policy proceeds. So details are not required over here. So if you will receive anything from this policy, it is totally exempt. Foreign currency for private use. If you will have any foreign currency, it is totally exempt. Work of art given for national use, just like portrait of any national hero, totally exempt. Gilded security, students. Uh, any type of certificates or securities are totally exempt. Qualifying corporate bonds, company loan notes, chattels. What are chattels? Basically, tangible and movable assets are called chattels. For example, jewelry could be example of tangible and movable assets. So all those assets which are tangible as well as movable are called chattels. There is a detailed topic on chattels. That's why I have written the word some. So few chattels are exempt and few chattels are chargeable. Investment in ISA. ISA stand for individual saving account. If you have deposited your money into individual saving account, in that case, the bank will deposit your money, the bank will invest your money into different shares and securities, and any return in the form of capital gain from individual saving account will be totally exempt. Prize and betting winning, so it is also tax free. Uh, in short, you can say current assets, all type of investments in debts, You can see there is the word certificate over here. And there is a word security over here. There is a word bond over here. So all type of investments in debts are tax free. Either it is loan notes or debentures or securities or bonds. So all types of investments in debts are totally exempt. So current assets, debts, cars. Okay. Others are also important, but these three, four assets are very, very important. So you should at least remember these four types of exempt assets. So this is basically the list of exempt assets. All other assets are called chargeable assets. For example, land and building, goodwill, short lease, long-term lease, unquoted shares, quoted shares, unit trusts, chattels. So we will discuss all of them later on in this chapter. These are all chargeable. Third term is basically disposal. Disposal means transfer of asset. Please remember, disposal doesn't mean always the sale. Disposal means in this typical area, disposal means transfer of asset. For example, asset can be transferred through sale, through gift, through theft, through damage or destruction. So these are basically few examples. So disposal means transfer of asset. In each case, rules are different, but in each case, whenever asset will be transferred either through sale or gift or theft or damage, so there will be CGT implications, but obviously the rules for the calculation of the capital gain will be different in each case. Now, the important thing over here is disposal proceeds. What are the disposal proceeds in each case? In case of sale, sale means sale at market value. If we have sold an asset at or above the market value, no issue at all. Disposal proceeds will be equal to your normal selling price. But sale at undervalue. If you have sold an asset below the market value, please remember it is also example of gift. If you have sold an asset below the market value, or you have gifted an asset without receiving any consideration, in both cases, it is considered as gift, and in both cases, disposal proceed will be market value. Third one, in case of theft or destroy or damage, there are special rules. Because in these cases, we will have to consider the insurance proceeds. So we will have to check with the insurance company Either we have received any insurance proceeds or not. So calculations will depend upon insurance proceeds in these cases. So that's why there are special rules for the calculation of gain or loss in these cases. Next one is date of disposal. Students, normally the date when asset has transferred is date of disposal. Date when risk and reward are transferred. So the date when we have transferred the asset, normally on that date, all the risk and rewards are transferred. So that would be the date of disposal. But sometimes there are contingent contracts. Contingent contract means there are contracts in which there are different conditions to become legally binding. So if all the conditions are satisfied, only in that case contract will become legally binding. Otherwise, it is not a legally binding agreement. So in case of contingent contracts, it will become legally binding when all the conditions are satisfied, and that date will be date of disposal. There is another point over here, that is death transfers. Means asset transferred after the death of an individual. So at the start of the capital gains tax, I have already discussed this point, that capital gain tax is typically lifetime tax. It is not applicable on death transfers, no CGT implications. But we need to consider one thing over here. One is deceased person, and the other one is, you can say, donee or beneficiary. Okay, so deceased person and beneficiary. At the death of this deceased person, suppose land building having market value of 800,000 pounds is transferred to this beneficiary. So there will be no CGT implications for the deceased person, but for the beneficiary, cost will be probate value. Okay, so probate value means market value of an asset at death date of an individual. So the market value of the asset at death date is 800,000 pounds. So for the beneficiary, cost will be 800,000 pounds. Whenever the beneficiary will dispose of this asset in the future, the beneficiary will use 800,000 pounds as the cost of this asset. Okay. There is a note over here. Same rule apply for spouse. So if the deceased person is any party in the spouse, for example, husband died, and land and building owned by the husband is transferred to wife, so same rule will be applicable. Normally there are different rules for transfer of asset between husband and wife, but if the asset is transferred at the time of death, in that case this same rule is applicable for every individual including the spouse. So what are the normal rules for the spouse? Let's discuss over here as well. Transactions between spouse. So in case of any transaction between husband and wife, disposal proceed will be cost. Means all the transactions between husband and wife will be at no gain, no loss. And actual selling price will be ignored. For example, husband purchased shares in 2006 for £20,000 and sold them to wife for £38,000. Even though there is actual selling price over here that is £38,000, but still because it is transaction between husband and wife, so for the husband, simply you can say disposal proceed will be your cost. £20,000. So disposal proceed will be cost will be cost. So you don't need to prepare these calculations. Simply you can write down transaction between husband and wife, transaction between spouse. So no gain, no loss. So you don't have to prepare this calculation. For the wife, cost will be £20,000. So cost of one party will become the cost of the second party. There will be no gain, no loss. Simple as that. Whenever the wife will dispose of this asset in the future, cost will be £20,000 for the purpose of calculation of gain or loss. So in this way, we will calculate gain or loss in case of transactions between husband and wife. So these are few points related to CGT. When a chargeable person makes a disposal of chargeable assets, then the fourth point is chargeable gain. We are going to calculate chargeable gain on the fourth step, and on this gain we will calculate tax that is called capital gains tax. When a chargeable person makes a disposal of chargeable assets and realized capital gain, on that capital gain there will be a tax. That tax is called capital gains tax. Now let's discuss our next step, that is chargeable gain. For the chargeable gains, things are very simple. Simply, if we have purchased an asset, suppose we have purchased land and building for £400,000. And at the time of the purchase, there are few extra costs related to purchase of this property. So any extra costs are called incidental costs. So at the time of purchase of property, incidental cost was incurred amounting to £10,000. So incidental cost could be any cost at the time of purchase of property. For example, any legal documentation cost, maybe valuation cost, maybe any type of tax that is which is non-refundable, maybe commission paid to the property agent. So any cost related to this property at the time of the purchase of the property other than the purchase price is called incidental cost. So we will add it in our purchase price. Then disposal proceeds, selling price. So suppose we have sold this asset after a few years for £600,000. Same is the case with incidental cost at the time of sale. So maybe we will have to pay commission to the agent at the time of the sale. Maybe we will have to pay any type of tax. Maybe we will have to pay valuation charges at the time of sale of property. So any extra cost incurred at the time of sale or purchase is allowable. These both costs can be deducted from the selling price. Suppose incidental cost at the time of the sale of property is 30,000. So £160,000 is basically capital gain. We will calculate gain or loss on every asset in the same way. Selling price minus all the relevant costs to calculate gain or loss. So we will calculate chargeable gain on every single asset in this way. Then we will calculate net chargeable gain. So net chargeable gain means if we have loss on one asset and we have profit on the other one, then we will net off these profits and losses. For example, on asset one, we have profit of £160,000, and on asset two, we have loss of £50,000. So we will calculate our net chargeable gain, which is £110,000 over here, and CGT implications will arise on this net chargeable gain. Students, if you have any question, you can ask. Any questions? Students, today was just an initial introduction class because exams had just ended yesterday. So there were a few students who requested to delay the classes. So that's why, because it was planned to start the classes in this week. So that's why we have started the introduction class today. Tomorrow is off. It means our syllabus will start from next weekend. Okay, so tomorrow is off. Our syllabus will start from next weekend. Today was just a short introduction class, and we will have our next class on next Saturday. So every Saturday and Sunday, we will have a long session. So we will have 1 hour or maybe 1 hour 20 minutes class. Then we will take break of few minutes, and then we will have another 1 hour session. Okay, so around 2 or 15 minute session will be either with break or without. So in total we will have 2 or 15 minute session on Saturday, and we will have 2 or 15 minute session, roughly speaking, so on Sunday as well. So thank you everyone. See you on next weekend. In the meantime, I will prepare notes for you guys. So I will share the notes with you guys before our next live session, which is on coming Saturday. Thank you everyone. See you in next live session.